Hello and welcome to Idea to IPO. I'm Jennifer Stowell, and Idea to IPO has been holding tech startup events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 150,000 members among all of our meetup groups all across the world, and we have organized, promoted, and produced over 2,639 events. By any standard, by any measure, we are the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we are 100% online. We hold an event nearly every day of the week. Check out our schedule at ideatoipo.com. Our featured speaker today is Jason Putnam-Gordon, one of the top venture capital attorneys in Silicon Valley. And he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Jason Putnam-Gordon. Jason, take it away.
Hi, thank you very much, Jennifer. It's great to be here tonight. Thank you very much, Rob Lau and Idea to IPO. It's always a pleasure to be here. Been doing events with Idea to IPO since 2013. And first it was in person, and today it's virtual. I think one day we'll be in person again, hopefully pretty soon. So we've got an exciting event for you tonight. We're going to talk about how to structure your venture capital term sheet so you can get a win-win deal. It's a topic that's near and dear to my heart. But before we jump into it, let's cover what we're going to do today, both in terms of just today's format, and then also just some of the nuts and bolts and operational things going on here. So not only am I speaking, but I'm running the tech in the background. So bear with me and help make it easier on me. So rather than using the chat function, if you've got a question, use the Q&A function. I'm going to be tracking that. Otherwise, I've got sort of a billion different windows open. It's kind of hard to focus on all of it. I want to be here and in the moment with you. Now, in the meantime, we've got an audience survey poll that's open. So what I'd like is, as we're getting started, as folks are still coming in the room, please fill out that poll. It helps give me a sense for who's here, and I'm going to try and tailor my conversation to who's in the audience today. Now, with that in mind, today's event is recorded. So two things. One of them is if you missed some or all of the event, it's great. You can catch it later. A second thing is, what you say is going to be memorialized for posterity, and it's going to be potentially available on the internet because we're going to circulate this event to people afterwards. And I know that Idea to IPO frequently will post these videos on its YouTube channel. So please don't give us any confidential information. It's not appropriate in this venue. Now, sort of the third bonus thing there is if you're unable to make it because you're outside of the US or tonight's and now is not convenient, so long as you've registered, you'll get it. So we're gonna have a lot of folks who are gonna probably view this not live, and that's okay. So today's format is I'm gonna speak for about an hour. I'd like to make it engaging, so please use the Q&A function if you've got some questions. If it's on topic and in line with the content of where I'm at, I'll try and address it. If it's not, we'll either, address it when we get to that part of the content, or, we may hold it towards the end. And if we get a lot of Q&A, which is fantastic, and I like to get that, I'm going to focus first on answering questions that are related to like the most number of people. It's sort of pertinent to the largest audience. And the other thing too is I do keep office hours. So if you want to connect or have a live conversation, you can either send me an email, jgordon@pulsanla.com. Don't put any confidential information into that. I'm going to move into my caveats here. Or connect with me on LinkedIn, especially if you just want to see what's coming down the pike, what's next event that I'm doing. So in line with my advisement not to give me any confidential information, let me give you some background and some caveats. So today's discussion is going to be general information. So this is going to be giving you a framework and an understanding for how we typically negotiate venture capital term sheets and how to get a win-win deal out of that. It's not going to be advice that's specific for your circumstance. Why? Because I'm not going to know enough about your situation to give you specific advice. And, rules and other things, there are exceptions to those rules and exceptions to the exceptions. So, whether it's a conversation, whether it's a question that I answer today, or if we get a little deeper in it, or even sort of a follow-up conversation that we have, unless and until we're actually technically engaged, this is general information. And of course, you don't have to engage me. It's good. This rule applies kind of to any lawyer who you'd probably work with. So with that in mind, let's hop into sort of the overview of how things are going to go today, what we'll talk about. So talk a little bit about my background and why it is that I'm sitting in front of you talking about these things. And then let's talk about what we'll cover. So we'll talk about what a venture capital financing is. We'll talk about how venture capital financings fit into the business model of emerging growth companies, which is a fancy term for startups. We'll talk about what venture capital fund investors look for in an investment, and also what strategic investors look for in an investment. And we'll talk about what's the difference between the two types of investors, and sort of the costs and benefits of having one type or both types in around. We'll talk about who makes a good venture capital investor, some things you may want to take a look out for, both positive and negative. We'll talk about why it is critical to run pro forma cap tables before you do a financing, before you even start negotiating the financing. And then we'll talk about common negotiated terms, and how to handle requests for side letters. And then we'll talk about pitfalls and other mistakes. So that's what we've got on the docket. It's going to be a fun topic. Let's see who's in the room. So we've got about a quarter of the people from the Bay Area, 10% from California, another 25% from elsewhere in the US. So we've got about 60% of the people from the US, let's say 65% if you're including all of North America. We've got some folks on from Africa, Asia. I've got Africa twice in there. I don't know why I did that. And then some folks from somewhere else, which could be the Middle East, let's say. Overwhelmingly, we've got first-time entrepreneurs in the room. Awesome. And then we've got a couple serial entrepreneurs, a couple corporate VCs, some traditional VC players. We've got some folks in academia, some students, and we've got some folks in the government. And then we've got folks who do other things. So I'm going to share these results quickly. And let's kind of move on. So who am I? Why am I here? That's the topic for a whole different day. But let me tell you a little bit about my background. So I'm a venture capital and emerging growth company attorney. I've been practicing law since 2005. What does a venture capital and emerging growth company attorney do? So I work with startups, from formation through their financings, through their exits. I serve as an outside general counsel for their legal needs, helping to basically be air traffic controller, helping them identify spot issues and get those resolved with regard to items like employment, IP, taxes, international law, all kinds of things along those lines. But my core area of practice, again, is corporate structuring and financings and exits. And on the VC side, I help VCs deploy capital. I'm not the fund formation guys. Those are a different group. That's a topic for another conversation. So I'm at Polsinelli, which is an Am Law 100 firm with approximately 900 attorneys in the US. We are US based and focused. I'm in our San Francisco office, but I work with companies throughout the rest of the world and throughout the rest of the US. And that's one of the nice things about being in the Bay Area is that it's a destination. I love working with as outside general counsel with entrepreneurs and also with their financings. I have a little bit of an entrepreneurial bug. Before I came back to working at a big firm, I ran my own shop for about 5 or 6 years. I feel like that I can really identify with my clients on that aspect because I know what it's like to build a company from scratch. So that's exciting. So let's talk about maybe who's going to get the most value out of today's conversation. So I think folks who have never raised capital before and who are an emerging growth company, I think you're squarely in the right spot. I think it's not too early if you're about to do like a convertible round or a safe raise. I think it's important to be thinking about these things at this point in time, and we'll kind of talk about that as we move through today's content. I think the other folks who are going to be really helpful is if you are doing a venture capital raise or you're thinking about it. So I'm going to just pause here. Yep. Okay. There's a question about safes and convertible notes. We'll get into that in a second. But let's talk about what venture capital financing is. Okay. So a venture capital financing is a priced equity raise. So usually by a financial venture capitalist, but could also be by a corporate or strategic venture capital arm of a company. By priced equity raise, what we mean is you're selling a chunk of the company, and more specifically, you're selling preferred stock. There are two types of stock. There's common stock, which is what basically everybody other than your investors are going to get. And there's preferred stock, and preferred stock is stock that has what we call preferences. And those are attributes that give certain bells and whistles. So for example, maybe they get paid first on the exit. That'd be like a liquidation preference, or they get a right to elect a special director seat, or they get a right to veto certain corporate actions. We'll talk about those a little bit later today. And one of the reasons why we have venture capitalists and that we have emerging growth companies is that there's a lot of technology and other things that are coming out that requires a lot of capital to grow and scale quickly. And so, you know, since the 60s, venture has evolved, let's say, and, you know, what it's come to basically be today, especially if you're talking about traditional financial VC, is that, you know, there's a fund, it's got sort of a 10 or 12-year lifespan. You know, over the first sort of 7 years or so, it's going to be deploying its capital. And the goal of the fund is to invest in a couple of home run companies so that basically, you know, they will be able to make their return to their investors within that period of time. Now, for those companies, we're not talking about companies that need to raise $100,000 or $200,000 or $1 million. I mean, we're talking about substantial amounts of capital. And so, you know, what we're talking about also is it's the model for VCs is that they get their money back for their investors. So they're looking at basically having that company or having an exit, having some sort of liquidity event where they can get the capital back from their investment over that period of time. And that's going to happen sort of in a 7-year time frame, plus or minus a couple. You know, the popular sort of goal typically is to do an IPO, but much more likely, even if you have a very successful company, you're going to end up doing some sort of merger acquisition exit. And what I want to do is I just want to sort of show the startup financing life cycle, because I think that it's really important for first-time entrepreneurs to kind of understand this. So early on in the company, when, you know, basically your net revenue is negative, right? You're just burning a lot of cash. You're in what we call the valley of death. That's when you're doing this sort of seed and angel round. That's the period of time where you are getting together your initial team, you're getting together your initial prototype, maybe starting to go out to the market, starting to get up a few sales. Typically, a more traditional venture investment kind of comes in after you've worked out the kinks, gotten that initial team together, gotten the initial, you know, product or service together, and you're starting to get customers. And now it's time to scale. And that's when the venture investors are sort of much more likely to come in and to make their investment. And we'll talk about that in a second. And so what's going to happen is they don't give you all the money up front, and we'll talk about that a little bit more later. You know, typically venture investors will kind of syndicate or go in with a number of other investors. There'll be a lead and some follow-on investors, and you know, they'll stage out in rounds. And what you do is you go out and you know, put together your business plan, you put together your materials, and you sort of pitch this plan. You know, put in $5 million into my company and I will do X, Y, and Z, and I will double or triple the value of the company between now and 18 months from now. And that's when we're going to do another raise, you know, and at that point I'm going to need this much capital. And that's why we see this stair step here. And you sort of see the revenue going up around that point in time. That sort of doesn't necessarily apply to your company, but that's sort of what we typically see. And on the right-hand side, you know, in blue, we see the percentage of ownership that the founders have. And we see that as on a percentage basis that decreases over time. But if you look at that line or chart, that's a chart that sort of charts the value of the company up to $1 billion. And again, this is sort of like a composite hypothetical situation. But that's sort of the life cycle, right? So company becomes more valuable, chunks keep getting sold off, founders get diluted, but their stake is more valuable. And we'll talk a little bit about that more later today. Let me pause because we got a question, which I'll just knock out real fast. It says basically, given that almost there are zero interest loans available, are safes and convertible notes attractive? The answer is absolutely yes. The types of investors who you'd be raising from on a safe or convertible note is very different than what you'd be doing from a loan. Usually when sort of one of the advantages is, and sort of here with this ecosystem, these investors understand that this is a high risk endeavor and they're only going to get paid, and they're going to get paid handsomely if the company does very well. And if you go out and get a loan from a bank, you'll probably have to personally guarantee it. So even if that interest rate is low, we don't see a lot of founders doing that. We do see some situations where they do that, but usually they're sort of special situations. So yes, safes, convertible notes, still super duper attractive. No, I actually don't have a Twitter. Well, I've given up my Twitter account a couple of years ago. There's only so much social media that I can maintain, but I am on LinkedIn. So thank you. Do companies go to a later series financing right away at the start? I recently came across a company that spun off of its parent and did a Series C. Sachin, good question. Those do come up, right? So there can be spin outs and split offs and spin outs. And there's just a general naming convention, which is A, B, and C. And actually sometimes now it's super popular to do like a series seed, but you could really technically call it whatever you wanted to call it. And maybe they did that. I'm not sure why they did that, but I'm sure they had a good reason. And sometimes you call these things for somewhat kind of marketing reasons, basically. Especially we've sort of found that with series seed rounds, insofar as people like to do, a decent size series C, right? They'd rather do a series seed for 5 million and then do their series A at 25 million. It looks like they had a really big A round. It makes them feel like they got, they're doing a great job. It makes the investors feel that way too. All right. So kind of what happens in between, right? So you've got your business plan, you've been able to pitch it and sell it, and you got money in. Well, you're going to execute on that plan, and there's going to be inputs, right? The capital's coming in, the ideas are coming in, all the folks who you've hired, they're doing their thing. You got a well-oiled machine, and the company increases in value. And sort of at that point in time, that's what positions you to do that next round of raise, right? And at that next inflection point. That's the life. That is the typical life cycle for these types of companies. That is, by and large, the model. May not be right for your business. I don't know kind of who exactly is in the room, but there are lots of great businesses that are, not appropriate for venture capital financing, either because it doesn't fit into the model, or there are other ways to grow and scale your company, and that is totally fine. But that's who we're focused on today. So we're going to keep driving with that. So what VCs want? This is a great topic. I think one way to really put together and build a win-win term sheet is to understand or put yourself in the shoes of your investor, and also make sure that you also really understand your business and understand where you fit in the model. So you don't end up giving yourself any undue surprises in a negative sense. So what do they want? Well, they're beholden to people too. They're not, unless it's like a sovereign wealth fund or somebody who's, just the only LP in their own fund, they've got a job to do, and they've got a job that, they take in money from their investors, their limited partners called LPs, and then they have to go out and invest it in companies. So, they're building a portfolio. And as I mentioned before, the fund's life is usually around 10 years. And what do? In that period of time, they're looking for companies that are going to, at each one of those inflection points, kind of double or triple in value. And in that sort of span of time, we're looking at sort of 18 to 24 months, right, as they get that capital in and then they deploy it. They're looking for those companies to grow and scale like that. And they're looking to get a few home runs in their portfolio. So they're looking for companies that are going to sort of, I don't know, 5 to 10x, whatever their investment is, to make up for a lot of the companies that don't make it. And I don't know exactly kind of where I got this from, but I've been trying to focus more and more on putting together some acronyms or some other things that I think will be helpful. So the way that I sort of view what VCs want to do is they got to get this return. So one component is looking for that model that's gonna achieve their return. That's sort of 5 to 10x, let's just say, over a 5 to 7 year period. And then they're looking at things, and they're looking at a couple of buckets at risk, right? Like, what is it that we can control? What is it that we can understand? What is it that we can control? What is it that we can influence? So within that, you know, the sort of acronym that I've been playing with these days is TERM. So they evaluate investments for sort of the technical risk, like, does the technology work? Can it be achieved? The execution risk, do we have the right team in place? Do they have the right strategic relationships? You know, both on the supply side and the sales side. Looking at the regulatory risk and political risk, right? So 10 years ago, if you are, in the ride sharing business, you'd say, oh, there might be quite a lot of regulatory risk there, right? There are all these taxi driver regulations and other things. So, you got to, as an entrepreneur, you need to evaluate these types of things. And just because that's out there doesn't mean you can't get by it, right? You can't overcome that issue, but you should at least have a plan or strategy that you're going to take out to your investors. Let them know, how you see the world. Let them know you've identified this risk, and let them know how you plan to deal with it. They can agree with you or disagree with you. And then market risk, maybe the biggest one, right? So are people going to actually buy that good or service? So in that bucket, VCs try and limit this stuff. So as we talked before, I talked about how usually there's sales, right? That's one way to gauge the market risk, right? Do you have customers that really love your product, keep buying it? Okay, that's that market risk. The technical risk, VCs employ lots of technical experts and have, all kinds of advisors and other folks who understand the area or sector that you play in, so they can evaluate that. And then they've got their own lawyers, so they can evaluate, and their own sort of other consultants, so they can evaluate the regulatory and political risk. Let me tell you what it's not about, or at least by and large, especially if you're talking about traditional financial venture capitalists, right? It's not about controlling your company. They're not in the business of controlling your company. Taking control rights or having control rights is about risk mitigation for them, about helping them get a sense to make sure they can achieve the returns that they need to achieve. And so similarly, as it's not about control of your company, it's also not about running your company. So some of the other ways that they can kind of mitigate some of this risk is, usually, as I said before, these rounds, there are multiple investors coming in these rounds, 5, 10, more, whatever, 2, 3, 4, 5, 10. You get too many investors, it becomes very expensive, a lot of cats to herd, don't necessarily recommend it. But that way they're saving some dry powder to deploy in later rounds. And we can talk about pro rata rights and other things of what that means later, because pro rata rights is sort of one way that they get to ensure that they can deploy that capital later that they have reserved. But there are other, right? So the mechanics are they save some money for later by bringing in other people, so they don't have to fully fund it. They've got spaced out over rounds, so they can see that you're hitting milestones and metrics, and they're feeling comfortable that that valuation is actually really growing and increasing. And then there are protective provisions and other rights, which we'll talk about. So we talked about financial investors. We've talked about sort of the mechanics of how they, in the world in which they view risk, some of the things they do to mitigate it. let's talk a little bit about strategic investors who are playing a bigger and bigger role in the ecosystem, which is super exciting. They've got different considerations, and you're going to have different considerations when you deal with them. Many times for strategic investors, it comes into a couple of buckets and things, right? So they are ultimately, usually they're trying to grow their business. Okay, so there are a couple of things they could be doing to grow their business. They could be focused on nurturing their corp dev pipeline. What does that mean? Well, lots of companies find that it's hard, especially really large companies find that it's hard to innovate. Like the folks who have the appetite and the risk appetite and the desire and drive and aptitude to build, do new things, create new products are not the same kind that's going to work for like a big company. So large companies have clued into this and they acquire other companies, right? So that's what we're talking about when we're talking about the corporate development pipeline. Other things that they're focused on, right? Because it's kind of about growing their business most of the time. Building new ecosystems to support their products, right? So if you are a corporate venture capitalist or, one of the things you do is your company makes, let's say, chips or lenses or, software, back-end software, cloud computing, let's say, right? You want more and more people to be buying your services. So, you may be basically supporting, the folks who are going to be your customers eventually, build out their businesses so they'll buy more and more of your services. And then the other thing too is, they're always looking also for new opportunities and new markets and maybe a convergence, right? Who would have thought 30 years ago that the infotainment systems in cars would be as sort of integrated with the major technology players as they are today. So, there's a lot of convergence going on. So there's a lot of play in there. So they've got different motives, but ultimately it comes down to growing their business. All right, we've got a question. How do VCs know the health of a company that they invested in? Are there reports that the startup is required to give them? If there are reports, what are they called? Well, there's kind of when in time are we talking about? So before they make the investment, there's extensive diligence, and that's actually, I'll touch on it briefly, but I have a deep dive on venture capital rounds, and that's probably more appropriate if you tune into that. Send me an email and I'll send you a video to that. But the diligence process basically involves them going through all of your books and records and looking at your financials and looking at your business plan. Spending a lot of time poring over that and going over it with you before each round. Now, after they've made the investment, frequently they're going to get information rights. So they'll get the rights to your, your income statement, your balance sheet. They'll get that probably on a quarterly basis. Depending on how far along the company is, it might be audited. Additionally, if they're major investors, they may get inspection rights. That is, they may have the right to ask for additional books and records and or even show up at your place of business unannounced. So they can take a look around and work with you on those types of things. And in one sense, you're not ever required to give them anything. But then again, they're also not ever really required to become your investor. So you negotiate these things up front, and that's how that gets handled. Okay. Got a couple of questions in the chat. As I mentioned earlier, please use the Q&A function. It's easier for me to monitor because I'm running this by myself. And then the other thing is, yes, you're going to get the video later if you registered. It'll probably be a week or so, but it will be out there. What's the difference between each series round? Does each round mean further maturity in the raise? Well, sort of ideally, if the company is doing better and better, it's kind of more of the same rights for the investors. But the valuation of the company was hopefully increasing. So, although you may have raised 5 million in your first round and sold 20%, or let's say 30%, in your next round, you may raise 50 million, but only sell sort of 15% or 20% or so, something along those lines. If you're not doing so well, you could have what we call a down round, and that's where the valuation of the company actually goes down. And that triggers a whole bunch of other issues, which we'll touch on briefly. Are many VCs scared by strategic investors based on their concerns of steering the company towards less valuable directions or having access to key information? Do you feel like this is still an issue for most VCs today? So in my experience in reading the market trends, having strategic investors has really like sort of juiced the market substantially. The companies who have like a blend of financial and also strategic investors in a round, in the correct rounds, was sort of usually at least later stage, they get the highest valuations and they raise sort of the most money, take the least amount of dilution, and have the best terms. What does that mean and why is that? I think it's a sign of health, and traditional financial VCs, financial investors are looking for a return, right? So, if they see there's a clear path and exit, that's a risk that's kind of off the table for them. I do think some of these questions with regard to access to key information and sort of lock up on commercial rights and other things that pop up from time to time, that's an issue and something you need to work through, especially before you're going to give a board seat and before you give observers rights and before you, some of those other information rights may need to be narrowly tailored or may need to have exceptions for, preserving your trade secrets and, preserving attorney-client privilege. Will you be providing a term sheet template of sorts, the basics of what a term sheet should say? Great question. We'll talk about that a little bit later, but I think a great model to take a look at is the NVCA standard form. So go to nvca.org, or type in Google NVCA financing documents and check that out. You can also go to seriesseed.com for a slimmed down Series Seed style financing term, but that people have really moved away from that in the last 5 years. So that deal is not really nearly as popular. VCs assess startups financials to assess overall risk. How about the cybersecurity risk? Cybersecurity violations like GDPR and CC privacy laws are very big fines that can impact financials. Wondering how, yes. Yep, hey Kevin, absolutely. Thanks for asking. They do check that out. And they're gonna, the further you are along, the more customers you have, the sort of more likely it is that that's gonna need to get tied down before you do the round and raise. Super early stage, kind of everyone understands you've been out there building your products, not necessarily hiring as much money or spending as much money as you should on lawyers, or we would like you to spend on us. How do entrepreneurs know when to have the next round of investing, and how many rounds of investing do they have before an IPO? I'm going to take this question, and then since a whole bunch are coming in, and that's fantastic, we're going to keep moving through the content. So how many? Just sort of depends, right? Some companies go IPO without ever doing a venture round. I mean, I think you're looking typically at sort of 3 or 4. And how many rounds? What you should do is you should put together that business plan. How much money you're going to need to raise in order to get to that exit point? How can you break that up into sort of segments where, here we're putting together our initial prototype and team. Here we're going to get our initial sets of customers. Then we're going to scale this much. Then we're going to go after this market and sort of break it up that way. And then you got to sell that to the VCs. Also, who can help advise the company on when to have the investment rounds and what to do with the money and where to take the company? So I did a talk with, so they're outside CFO consulting services. I did a talk 2 weeks ago, which I'm going to plug again because it's on the Idea to IPO YouTube page with supporting strategies. I mean, someone along those lines might be, or probably in a good, depending upon your vertical, might be a good fit for you. Feel free to send me an email. I do keep office hours. We can sync up later if that's better. All right, let's move on. We're getting a lot of great questions, but we also got a lot of great content. So let's keep rolling. What do you want in a VC? So this is my first time actually doing this particular one. So I actually meant to just delete this and like leave it open so you guys could kind of stream in some stuff from me. But let me tell you some of the things that entrepreneurs are typically looking for when when they've got, or what we'd want them to look for. There are a couple different types of VCs. So we talked about corporate, right, and strategic investors. On the sort of financial side, there are typically sort of generalists who will invest in a wide number of different wide-ranging sectors. And then there are specialists, right? It might just be people who focus only in life sciences or only in SaaS companies or, only in AI or something along those lines. What you're looking for typically is investors, you're looking for smart money. Okay, so you're looking for investors who are familiar with your particular market. One sort of real key or cue in for this is like, if you're talking to them and you're telling them what their business plan, and they're just kind of looking at you like, what is this? Could be one of two things. One, you could be crazy and off the wall, and you kind of would know that if you were talking to somebody who was in your space, but maybe not. And two, you might not be talking to the right investor, all right? Because investors are people, they only know so many things. You want investors who are familiar with your space and what it is that you're doing. So they've got the patience, they know what it's going to take to build and grow this company. They also probably will have relationships to open doors for you, open doors for to get other investors involved, right? Because it's not usually one VC putting in all the money. There are 2, 3, 4, 5 plus that will typically come in and around. They may know suppliers that you can work with or other vendors. They may also know customers. So that's kind of what you're going to want in a VC, typically. How do you find them? How do you find them? That's a great question. So here's my spiel on that. Before you need the money, figure out who's got the money that you'd want to have as an investor. Where can you find that information? Well, 20 years ago, you probably have to be hanging out at some athletic club somewhere to kind of know what that is. But now, there's PitchBook, there's Crunchbase, there's TechCrunch, there's Google. So you should be able to identify funds that focus, funds, whether they are corporate or traditional, that focus on your particular area and niche. And first and foremost, raising money is sales, okay? And I don't mean that in sort of cheesy sense. It's just you're literally selling a piece of your company. So you got to build that funnel. And you got to get warm intros and other things that you need to get sales. So do your research, do your homework, figure out who would be a good fit, figure out what makes them tick, okay? Figure out what other investments they've made, okay? A couple reasons. You may not want to go to them if they're a competitor. If they've invested in a competitor, if it's too close, because you will not be able to, certainly traditional VCs, you will not be able to get them to sign an NDA, absent very special circumstances, not worth going into on here. And so, you're going to want to build that list of who you want to talk to, who's a good fit. You're going to want to figure out who within that fund, because even if the fund invests in a specific sector or niche, there's probably a partner or two that focus in sort of a sub niche, particular area. You're going to get the best chance of kind of getting connected to somebody who knows your space if you figure out who's been playing in your space. Do your homework on that person. So again, see what other companies they've invested in. Many times, to get deal flow, those folks are out speaking. You can watch them. You can hear them talk about what it is they invest in, what's a good fit for them. Sometimes on their website, they also, they'll either have a blog or they'll provide you with other information for what they're looking for. And then, look at your network. Are you on LinkedIn? Do you have any connections? Can you get a warm intro? You're probably most apt to get a look over if you can get a warm intro. So that's kind of who you want, how you'll find them. Let's talk about some pre-round issues, and we'll just kind of fly through this because we go into a lot more depth in some other talks I have. But first, I'm going to take a water pause. Okie dokie. So before you go out to market, like make sure you got your ducks in a row. Make sure you got the right structure in place. So that's typically a Delaware C Corp. Now, there are lots of folks who set themselves up with LLCs, and if you're building a great company and you got sales and customers, that's not going to be the end of you. But at least out here in the Bay Area, it's super common just to get you set up with a C Corp to start with. Elsewhere in the US, some of my partners work elsewhere in the US. There are lots of LLCs out there. If you think back to one of my much earlier slides, I had a bunch of inputs that kind of go into the company and make it increase value. Make sure you got all those inputs tied out. So IP assignments, making sure all the IP is gained in there, making sure that the cap table, the folks who have equity or supposed to have equity in your company, have that all papered, properly approved by the board, authorized in the certificate of incorporation, and make sure you get vesting in place. If you don't have vesting in place, a couple things can happen. Someone can leave early and take a chunk of the company with them. And then I can't tell you how many times I've got situations like that where the remaining founders are displeased with the fact that somebody has left, took a huge chunk of that company, and they're kind of stuck. There aren't a lot of really great options. Sometimes even if you have vesting in place, you can end up in the same place, but it's sort of the best fix we have, best preventative medicine there. If you don't have vesting, you're going to need to get it in place before you close your venture round anyway. Just a quick plug, if you've got vesting, you're probably going to want to consider filing an 83B election. Let me just unpack some of that real quick. Vesting, I think, is a little bit of a misnomer. When people talk about vesting, they tend to think, oh, I'm going to get these shares of stock now, and then I'll get these shares of stock in another month, and I'll get these shares of stock in another month. I think the better analogy is say, like with vesting, you kind of get all of your stock up front. It's got strings attached to it. And as time goes by, those strings get cut. And if you leave, the shares that have the strings still attached to them, you leave behind, and the ones that you don't, you take with you. For tax reasons, the IRS it takes a position you don't have the shares until those strings are cut. And so one of the issues is if you've paid very little for them up front, but several rounds later when the company's worth a lot more, when that string gets cut, you're gonna have a huge tax bill. The 83B election is a mechanism around it. We're not gonna go into that, but yeah, just making sure you have all that stuff buttoned down. We can go into some of the stuff a little bit later if we've got some time for it. Yeah, I'm just taking a look at some notes here, making sure that I haven't hit on anything or haven't missed anything that we'd want to get in here. Okay, super duper uber important piece of information here. Build a pro forma cap table before you go out to raise, because so many times I talk to founders, maybe they've done a convertible note or a safe financing, and they say, great, I got this term sheet. At the end of it, I'm going to have, between me and my co-founder, we're going to have 20%, we're going to have 80% of the company. There's only going to be 20, we're only going to sell 20%. Well, that is not exactly what's going to necessarily happen. So I just kind of model another one below it. Here's probably what once the money comes in on the closing dates, this would be your post-closing cap table. Here's what it's kind of more likely to look like. Doesn't mean it's going to look exactly like this for you, but when you do your first raise, if this is what it looked like, wouldn't surprise me. You'll see the founders here still have the same 3 million shares, but they had convertible notes and safes that converted over, and turns out, all right, on a fully diluted basis, that is, when I say fully diluted, we could also have another sort of hour-long conversation about that, but suffice it to say, it usually means everything, like all common stock and anything that could get converted or changed into common stock. There's some caveats and asterisks there, but we won't go into that. But anyway, on a fully diluted basis, you'll see the founders have the same number of shares, but lo and behold, there were these safe holders. They effectively have 10% of the company. They cut a warrant to a supplier. And that's basically kind of like an option. It allows the supplier to, exercise and get some shares at a certain price. The preferred still wanted to come in at roughly 20%, and that would actually not be that much dilution, probably, sort of 20 to 25, maybe 30 is kind of common for the first price round. So, so you see, they still get their 20%, let's say. But you know what? This company had also, promised some options to some of its employees, and then they needed to have an available option pool, right? Because between this round and next round, you got a bunch of hires, and you're going to have to, issue issue options, grant options, technically. And if that option pool is not in place before closing, if it gets sort of bumped up after closing, then the new money is going to get diluted. They don't want that. They're wise to this game at this point, so they make sure it's all there. So run the pro forma cap tables, absolutely critical. So let's talk a little bit about the term sheet and the deal points, and then we'll kind of home in on a couple of these things. And that's great. We see a bunch of questions spooling up. All right. Sort of going back to what I said at the outset, I think the best way to end up with a win-win term sheet is to understand what is driving and what is important to your investors. And then also understand what's important to you and your company in its business plan and path, okay? With that in mind, probably the biggest thing for investors and the biggest thing for the company is how much of the company is being sold. Okay, and that's where the valuation piece comes in, right? You're really essentially talking about saying, well, I will sell you X percentage for Y dollars. And the pre-money valuation or the post-money valuation is really just the mathematical mechanism that we use to effect that and to sort of put a fine point and document everybody else's rights. And when I say post-money valuation, I and most people sort of define that as, the pre-money valuation plus the new money. So you can easily do the math, and the pre-money is the post-money minus the new money. So that's what you're negotiating about. So that's why it's important to build pro forma cap tables. Now, the reason why that matters are several fold, okay? They're kind of, again, a couple of things in play. There's sort of economic rights, and we'll talk about that. And we'll talk about sort of the biggest one, the sort of the one that sort of drives the game here. We'll talk about that in another slide. It's not dividends. And then we'll talk about those control rights a little bit, right? And that is, again, sort of a means by which not to take over control of your company, but to help the investors realize the gains that they anticipate receiving based on what you've told them, and to mitigate risk. So how much of the company is being sold? Critical. You can't do that without a pro forma cap table. You won't know what you're going to have left over. Now, why does that matter? Well, because you need to understand what the exit waterfall is going to look like. What does that mean? That means, well, if you build this company and you plan to exit when, the company is worth $100 million, how much are you going to take home? We'll talk about that in a second. That's in the liquidation preferences. Dividends kind of in early and mid stage doesn't really matter so much. Voting rights are important, okay? And that's usually there are a couple of things going on in there, but usually the preferred is going to vote along with the common for most typical things. And so, first rounds, most of the time the founders still control the company. Not all the time, but or either control or sort of effectively control. They come pretty close. But by later rounds, lots of preferred has been sold. So you need to understand, what constituencies you're going to need to build in order to effect other things. Protective provisions, those are basically blocking in other rights that the preferred are going to have, for things like, that would change the economics of the stock that they have bought, or, change the core component of the business, or do something that's going to kind of drastically change the desirability or the type of business that you're setting up, like, I don't know, a crypto offering, let's just say. Anti-dilution protection. That's the mechanism to protect the investors if there's a down round. So everyone likes to see these things go up and up and up, but they don't always. And, if investors overvalued your company, well, they want a corrective mechanism. There are a couple different kinds. The most common is broad-based weighted average. So basically you kind of take an average of what those first investors paid for their shares and the average of what the next do, and kind of get them topped up. You get them topped up that way. They don't actually get more shares. It just changes the conversion mechanism, conversion into common. But that's what that is. But there's also what's called full ratchet, which basically just reprices their shares down to whatever the new round is. Vesting for founders. So look, let's just say you started your company 4 years ago, you got vesting in place at that point in time. So you're fully vested. Or let's say you started your company 3 years ago and you had 4-year vesting, and you're what is that, 80% or 85% there. You'll have to restart some or all of that. The other deal points are who documents it. So out here, West Coast deals, usually the attorneys for the companies puts together the documentation. East Coast, Midwest, it's a little bit more of a crapshoot as to who does the first draft. It is common in a venture round to have the venture capital fund and other investors get some attorney fees, not necessarily all of their attorney fees. And most of the time, kind of in any situation, let's say you're selling a house, right? You want to have a whole bunch of bidders and buyers, but usually once you sign the term sheet, you're going to be subject to a non-shop. So you're not going to be able to take it out there and shop it, and also confidentiality provisions. And then another huge thing that falls into the control area is just the board seat, whether or not they should get a board seat. Depending on the size of the round and the sector, the investors may not take a board seat, but it's pretty common to have them at least get one in your first venture capital financing. Now, circling back to who wants to see an example of a term sheet, feel free to check out the nvca.org form of term sheet. It's super fulsome. You'll see why we get paid the big bucks to help you negotiate these things. Also, you can take a look at a lot of the standard documentation. Now, just because something comes from a form doesn't mean that it's easy or quick to put together. We have mechanisms to try and expedite this process, but it still takes a lot of brain power to get it all right. And there's usually a number of back and forths on drafting and finalizing these documents. So those are the standard deal points. Let's talk a little bit about kind of what the import of some of these deal points are. Let's then talk about the process of how you want to kind of go about this, and then we'll talk about some other things that pop up. Okay, what drives it at the end of the day is just for the investors, especially those traditional investors, is getting a return on their capital, right? At the outset, we talked about how they're looking for, an investment that in 5 to 7 years is going to 5 to 10x their return, so they can make their money for their investors. They can do their job. I'm sorry, I have to sneeze, so just bear with me a second. And then once you try, you never actually sneeze. If you've gotten, so here's an example where this company, and this is just sort of like a made up company, but they did a Series C, a Series A, and a Series B round. And you can see, based on the preference stack, that is, who gets paid first, those liquidation preferences, the common doesn't get any money unless the company sells for, I think, $12 million or something along those lines. Again, this is just sort of made up to just let you sort of see kind of how this works and what the effect is. I did a deep dive on dilution and these types of issues with supporting strategies 2 weeks ago. I put, this is the Idea to IPO web page, or excuse me, YouTube page, the videos on there. I encourage you to check it out. If you want to understand pro forma cap tables and dilution and how these things fit together better, check it out. It was awesome. It was really awesome. But yes, so you can see, let me just drive it home, that, usually what happens is the last money in is the first money out. That is, they get paid first. And, as a result, the common wins big if the company sells kind of later down the road, is worth a lot. But, if it sells earlier, it doesn't realize the return that probably the founders wanted. So let's do a little bit more of a deep dive into these control rights. So talking about electing directors, the mechanics there are usually the preferred wants to be represented, if you will, at the board, to keep an eye sort of on their investment and, to provide some guidance and input and other things. So, that's fine and appropriate in many circumstances. It just usually also is tied to a certain amount of the preferred being outstanding, right? Like if there's only one share preferred outstanding, they sold everything except for that, doesn't make sense. The sort of the incentives of the preferred and the sort of common are just kind of too far out of line at that point in time. So, it's important to understand how many shares you're selling so you can figure out these numbers. The protective provisions, which I mentioned, right? These are the ability usually of the director of the preferred to block certain things like selling the company or issuing crypto or, certain dividends or other disbursements. Putting someone else's like issuing new preferred that's going to sit above the current preferred in the preference stack. Again, sort of last in, first out. That's fine and appropriate. It's common. I mean, sometimes they're all pari passu, but it's fine and appropriate to have new money sit above the old money in the preference stack. But the old money is going to want to make sure they got a say as to whether or not they're okay with it. Changing the charter or bylaws, that's where you could sort of amend and mess with their rights. Changing the equity incentive plan. As I said before, you increase the plan after the round closes and you dilute them. So they don't like that idea. Changing the creation of debt. So debt sits above equity that is preferred or common in the preference stack. So this is important to them. Changing the board composition, they got a seat, and messing around with subs and kind of moving assets in out of subs, whether wholly owned or not wholly owned, kind of fits in there too. And then we talked about the voting provisions. So let's talk a little bit about process. I don't have a slide for this here, but I'm going to probably do it for the next one. So mark my words here. I think sort of the best process is to, sit down with your CFO, sit down with your lawyer in a conversation or two and sort of map out what you think, your business plan is, what the financial business plan looks like, and then identify what you think is a great term sheet for the company. Okay. And kind of after you've gone through that exercise, and it takes a lot of work because it's not just mapping out what you think is a great term sheet, like give me all the best terms. It's like, well, let's take a look and figure out kind of what we think, based on our anticipated growth path, are there any comparables out there? What else is, what does the market look like? What is that going to be for our pre-money valuation? What do those pro forma cap tables look like? So we can get a sense for kind of, what you're going to target. And then, the standard form really is these days is for, unless you've got a super duper hot company, and you've just got investors fighting to throw money into your company, it's going to be the investor that proposes the term sheet. And if you're lucky, you'll have 2 or 3 investors who may submit some term sheets. But I think doing a term sheet on your own, or maybe not a fulsome term sheet, but identifying in bullet points what the key terms are that you're going to be looking for is going to help you evaluate them. And then also sort of allow you, as you're having conversations with VCs, to sort of position yourself for getting that term sheet that you want, for knowing whether or not that's the right fit for your company. I think that's the best process. And kind of after you've kind of done that hard work, then you can go out and start building those relationships, or start getting ready to make those asks. Hopefully you've already started building relationships before you need to raise the money. Now, we talked about what's typically in the deal docs, let me tell you a little bit about sort of this sleeper issue that pops up and bites companies in the booty sometimes, side letters. So side letters are agreements that are outside of the financing documents, and they typically govern rights that investors want to have that for whatever reason, they don't want to put in, or the company doesn't want to put into the deal docs. And I always have to have a little bit of a question as to whether or not it's appropriate to do that. But, typically they govern things like board observer seats and preemptive rights. So that's, we talked about this way earlier. Investors don't put all their money in up front. They space it out. One way that they get to, and that's one way that they mitigate risk, right? If they just dumped in all their money right away, if you don't do a great job, it's gone. If you're doing a great job, well, they want to double down. I don't know if it's double, but whatever it is, inappropriate for their thing. And so their preemptive rights sit in that. It allows them to come in, gives them the right to come in to maintain their percentage or some portion of their percentage. Information rights. There was a good question earlier about, how is it that investors get to monitor their investment? Well, if for some reason they don't get the types of information rights that they want, or they want to have some right to give input, it might pop up in a side letter. And then there are other agreements that pop up from time to time. You want to, in one sense, you want to avoid doing side letters if you're a company side. You don't really want to have a side letter with every investor, because it's expensive to negotiate. There's frequently a bunch of back and forth on these things. Two, the other investors tend to see or want to see it, and then it sort of begets other side letters, which is kind of annoying. Three, man, you got to track all these rights, and it's not as simple as just looking in the financing documents, right? It's oh, I've got to look through all the financing documents, and then I also need to make sure that I've got my stack of 5 side letters that I got to follow. Or I need to sort of do a crib analysis of that, or an outline it, so to make it easier to find. So it's not great. I don't highly recommend it as a sort of standard go-to, but they can be necessary to get the deal done. We got a lot of great questions. Well, I presume they're great questions because you're all a fantastic audience. We're moving into the common pitfalls. So I'm going to just try and answer some questions and then hit some of these common pitfalls. All right, I'll tell you what, let me hit these pitfalls real quick. Negotiating before you run a pro forma cap table. I think we have sufficiently covered that. Securities laws issues. So in the United States and outside the United States, whenever you sell securities that are stock, convertible notes, safes, etc., you need to comply with securities laws. In the States, it's at the federal level. You've probably heard of the SEC before, and then it also gets regulated on the state level. Even if you're a tiny startup, these things still apply to you. The right move is to hire competent counsel to make sure that you've targeted an exemption and you can do that deal, so that you don't end up in a situation where either you get accused of securities fraud, or you have to give the money back and you don't have the money to give back. We can go more into detail on that later. On a related note, finders, those are people who are not licensed broker dealers who would tell you that they're going to connect you to capital in exchange for a chunk. It also comes up in some other contexts, but by and large, that's usually not permissible under the securities laws. Poor record keeping of your startup, similar to napkin promises. Again, there's the diligence phase. We talked about this before. The investors are going to want to, there's enough at stake that they're going to spend the time and money to evaluate your company. They're going to do diligence on it. So they need to see all the documentation around all the employees, all of your contracts, certainly all the important or material contracts, as we would say, all of your equity issuances, all of your debt issuances, all of those types of things. And not having that documentation doesn't necessarily mean the deal is dead, although it could kill the deal. But it usually does mean a lot of costly cleanup. So avoid those things and get your deal done. Have it be a win-win for you and for everyone else. With that in mind, I think we're going to transition on to the question and answer section. and comments. So we got a lot of great questions. I'm going to try and get as many as I can in the next 24, 25 minutes or so. I'm going to try and answer questions that have a wide applicability to the audience. So let me just see one other thing. How are these startups initially paying their staff in terms of developing their product, marketing, et cetera? Are they working day jobs and funneling into their salaries, into establishing the entity, assuming they have no friends, family, or investors to pull in that money? Being an early stage entrepreneur is not for the faint of heart and not for those without true grit, unless you're independently wealthy. There are lots of founders and entrepreneurs who grind two jobs, sort of, a job or two, or do Uber or Lyft, initially. At some point, if you want to have outside investment, especially at the VC level, a lot of VCs kind of use whether or not a founder is fully working for and fully devoted to that business and company. That is, they don't have another job, or maybe they're just sort of working a part-time job that doesn't take a lot of time. They use that as a proxy for whether or not there's a sufficient level of commitment. So it sort of depends, we could get into this whole, lots of times folks are paid as consultants, the staff, if you will, are paid as consultants, even though they might technically be employees, and that's not appropriate. We could talk about them being comped in equity, which is, if it's pure equity, it's probably not appropriate. But let me just suffice it to say, early stage entrepreneurs, there's a lot of grind, you need a lot of grit, and you got to figure out a way. And also, by the time you get to that VC level investment, unless you're a serial entrepreneur with demonstrated success, you're probably going to need to be doing it full time because that's what the VCs are betting on. Okay, great question. Do you have an estimate of dollar range represents the true seed stage and then an angel range? So these borders have gotten super squishy over the years. I mean, I would say, at least in the Bay Area, angels raising kind of, and I say it's gotten squishy because there are angels, there are super angels, there's band of angels, then there are micro VCs, all of them kind of play in the seed stage space. But, if we're talking seed stage range, I mean, I think we're kind of talking probably under 5 million, more likely 1 million, 2 million, in the Bay Area, price rounds are usually rounds that are usually north of 2 million, let's say, and more likely 3 to 5 and up, and probably be labeled as a series seed financing. There can be things that kind of drive it higher or lower. Outside of the Bay Area, we do see much more commonly sort of like price rounds start kind of around 1 million, but more likely sort of 2 million and north of 2 million. We don't see, when I do a lot of international work, or the international work that I do, typically convertible notes are more popular than safes. I hope that answered your question. You can ask another one sort of as a follow-up if you want. How do venture studios or startup studios structure in-kind services as a part of a term sheet? Are there in-kind services treated the same with cash and allocating the preferred shares, or is staggering based on delivery of services? So, I mean, there are just so many players in this space at this point in time that I'd want to kind of drill into your question a little bit more, but let me just zoom it out and make it generally applicable. If you're talking about incubators, accelerators, they have a couple of different mechanisms. Sometimes they'll effectively kind of do like a convertible debt, if you will, for converted into a certain percentage of the company. Other times they'll make a cash contribution. They'll do like a component that's like convertible debt or a safe. or some other like convertible equity, which is what a SAFE is. And then they will have some anti-dilution mechanisms to make sure they get their percentage. If you're talking about if you're talking about in-kind service providers getting, like, let's say, a convertible debt, one of the things that they should be concerned about is, income tax on that, right? So they may have income tax that's due on it, the same as whatever the value of the debt is, but they don't, you didn't give them any cash, so they can't pay the income tax on it. So depending upon who you're talking about, incubators, accelerators, these other sorts of folks who play like in the space, usually at the end of the day, they just want like a percentage. And so there are a couple of different mechanisms that we use to get them there. For university spinouts, what percentage of equity for the university might be a red flag for the VCs? Equity plus royalties for the university. Oh, I see what they're saying. What about things that would be, what about equity and royalties for the university? Would that be okay? So what I would do in this situation is, we've got some tech trans folks here at the firm who do this type of work all the time and kind of know what is market for negotiating that license coming out of the university. I kind of work in the background in that and sort of make sure that all the corporate stuff is buttoned up. But what's going to be focused on is, what is the entrepreneur's relationship to that university and that technology? Okay, sometimes they'll cut really sweetheart deals, if they were sort of their grad students or other folks, because they want to nurture the ecosystem. And each university is super different in terms of those deals that they cut. Some universities are super founder friendly, others are not. So you gotta weigh. You have to weigh what is sort of market in your particular situation. Additionally, I think in terms of red flag, the takeaway is, and I want to bring it back to this comment, the VCs have a job to do. That is to go out and deploy capital and get a return on that capital that is sufficient to meet what it is that they promise their investors. So long as they get their share in the company and they believe the company can grow and they can exit their share and realize the return that they need, that's what drives it. It's not necessarily a percentage. It's not necessarily a percentage of royalties, although they don't probably necessarily want to have a lot of cash going out. And they may end up with the same percentage. That the percentage that the university has is probably going to come out of the founders' hides. So, depending on the situation, they might not necessarily care about it that much, or as much as you might think they would. I would want a VC that had some good industry experience and connections that they would share. Danny, agreed. Thank you. Yeah, I know you're responding to my question earlier today, so thank you. Talking to investors who know your market space are also in a position to utilize your IP for startups in their portfolio. Okay, great, common question. Any suggestion on ways to mitigate that risk without turning them off by your concerns? Yes, so ways to mitigate it. Do your homework. Find out whether or not they have invested in competitors or you think they might invest in competitors. Control the amount of information or the level of information that you're sharing, okay? So you don't need to share with them your secret sauce in your pitch deck, right? You just need to share with that. And, we've got, especially my firm does a lot of work in this space. Although I do a lot of work in sort of health ventures and digital health and AI and robotics and that types of areas. But, I'm using your secret sauce because we've got a lot of consumer packaged goods companies, right? You can just send them your sample soda, and, with the deck and have them try it, right? Have them use or experience your products, something along those lines. So, controlling the IP that you're sharing with them is your best line of defense. And that is absolutely true whether you're talking about VCs or whether you're talking about, some joint venture with somebody else. I mean, an NDA is great to have, but if you're an early stage company, you probably don't have the wherewithal to pay the lawyers to go litigate it if your idea gets stolen. So the best level of defense is controlling the amount of IP that you share and the level of sensitivity of that. What is the norm of investing in advisors? Is it the same as founders? I would say, look, advisors kind of depends on what you're bringing them in to do and for how long they're going to be there, but 1 to 2 years is typical, and many times they sort of vest on a monthly basis. Again, may or may not be right for your situation, but that's sort of what we see. They're not all in, and if they're lending technical or other expertise and that value is sort of being realized in real time, you'd expect them to get their shares provided to them over time. Now, if it's going to take some time for their input to be valuable, well, then yeah, you may want to have a cliff. Okay, I don't think that's an answer or a question. Okay. Do stocks only invest with time, or can they invest in something else, such as a revenue goal? Yeah, you can tie stock vesting to performance. Typically we don't see that with regard to founders, because especially, and also early stage employees, because early stage the company is undergoing something, is just growing so much and changing, right? And there could be a pivot. You may pivot your product. First you might be going after the consumer space, and then you realize actually you're better, like way better at B2B. So you get those performance milestones in place, especially at the early stage companies, and you might end up kind of targeting the wrong thing, and then someone's gonna be cranky, or or if there's some dispute. So yeah, absolutely, you can tie it to something else. An example too, were the shares that were given during the seed round, where were the shares that were given during the seed round located? Let's go back. Oh, I mean, you can call it what you want, Series Seed or Series A. I would just say the 2 million shares are those were the shares that were sold in the seed round. The convertible notes and safes are sort of your angels and other folks. I hope that answered your question. During the new series rounds, B and C, are new stock created? Is that what dilution is? Absolutely, Danny. And please do watch. I think you'll, if you got another hour and a half, I think you'll love what we put together with supporting strategies. I was just so pleased with that. It's like even better than today's presentation. So I would definitely check it out. We will unlock the mysteries of dilution. How do you value the company? What standard valuation model for high-tech growth companies, X of sales factor growth? Bill, great question. Especially early stage companies, which we're kind of focused on here, since we've got 50% of the room are first-time entrepreneurs. There are a couple different models. If you go and look at that dilution seminar, which I just plugged, we go through a couple of them, but it's sort of by and large, early stage companies, before there's revenue, it's a little bit of a crapshoot. It's a little bit of, whatever you can convince somebody to pay for their percentage of the company. That's kind of it at the end of the day. Certainly when I'm working company side on those types of deals, I mean, that's always important to reiterate to the entrepreneurs. So, yeah, it's a lot of art, if you will. Bert's got a great question. How critical and sticky are the first round terms for follow-on rounds? And what's the ability to adjust that? Well, I think it's going to depend on who's in those follow-on rounds and, what their level of investment is going to be. So for example, if your first round was, let's say, like $2 million and you set up super cushy terms, and the company really hasn't done so well since then, you need to raise 3 or 5 million. I think those terms are going to get adjusted, towards the investors' favor, right? They've got leverage. If you're just killing it after that, you might have some wiggle room to adjust to a more company-friendly position. But by and large, I mean, I always try and structure these rounds thinking ahead, thinking that whatever is in place now is setting precedent. It's going to get, we're going to use it as a sword, as a shield against, new investors trying to come in and put in place less company-friendly terms. And, we'll use it as a sword and a shield basically for that. So yeah, there are departures from it, especially if there are a lot of money, a lot of new money is coming in. They'll frequently want to sit higher in the preference stack. Totally normal. There's a pricing question, Helena. I'd love to chat with you, during office hours or some other time about that. It's really just kind of hard to say. But needless to say, out here in the Bay Area, it's not unusual to see convertible notes or safes, safe rounds, in the millions, raising a couple million off of that. So, for a company that's raising that type of funding or that level of funding, I usually strongly advocate that they go down that path, at least on the expense side. And so, because it's a fraction, maybe 1/5, maybe 1/10 of what it would be to do like a full price round. And even then, it just sort of depends. I mean, there are sometimes you can end up with some inexpensive, relatively speaking, inexpensive price rounds, but many times, could easily be 6 figures. So safes or convertible notes usually for 2 million is what I'd suggest as my usual rule of thumb. What is the point in time and no shop clauses are enforced? Well, I think they're kind of, it's going to depend on the facts and circumstances. Certainly once you sign, you're going to be signed up for it. If there's been back and forth and you sort of indicated that you're going to honor that from the get-go, well, you might have sort of signed yourself up sooner. Additionally, there's a lot, there's what's enforced and what's legal, and then sort of the way that people act. And, if you're going to be out there dealing with investors, and you want to try and play one off the other, that can work, but you need to make sure that you've kind of gamed out how each of them is going to react, right? Some people react just fine with that. Some investors actually kind of encourage that. So, you need to be ready to be bound by that, certainly by the time that you have signed it. Can you elaborate on the techniques and ways of positioning to get the types of term sheet that you want? Well, one, as we talked about earlier, identifying what you want is key number one. Two, you're more likely to get what you want if you can end up in a situation where you've got 2 or 3 term sheets kind of coming in. So, kind of dovetailing a little bit with that no shop, you can let them know, look, we're talking to other investors, yada, 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 this is what we're desiring, we'd expect that you come in here. That's kind of it, right? Creating a deep market, a frothy market for your company is the way to position that. Now, how you do that, it's a little bit of the magic of the entrepreneur, if you will. Whatever it's going to take to drive that interest so that you can get 2, 3 term sheets coming in is what you want to do. That's what you want to do. Since most term sheets have anti-shop provisions, what are the best tips of suggesting to stall while quickly informing the other interested investors they need to produce a term sheet? Well, again, hopefully in getting that first term sheet, you probably let them know you're talking to other people. They should know that. So I think I'm usually kind of like an honest guy and just sort of think, especially if you're going to have these people on their cap table or they're already on their cap table, you're going to be in the repeat player business with them. So you don't want to burn them. So you gotta just manage that relationship, right? We're talking, depends on the actual situation, but many times sort of the golden rule is sort of the best, right? Treat others as you'd want to be treated. All right, fine, I understand. You know, you've got other people you could sell that car to. You've got a right to go out there and sell it for the highest price that you can. I'm using a car analogy here. And you can be honest. Well, we're expecting another term sheet to come back, yada, yada, yada. Or, you know, I think that's probably the best way, is just to, you know, keep people clued in on the process, right? Because what you don't want to do is end up in a situation where someone gets pissed and loses interest, and, you know, you never got that second term sheet that you thought you were going to get. If you have 3 or 4 VCs in your startup company as part of the board of directors, who should be responsible if the disagreement arises among the VCs? Look, you know, who can fire the other? Well, it's going to depend on the docs and the deal docs that you struck. So if you've got 3 or 4 different VCs on your board, you've probably got people with different designations. You've got maybe funds and or different series with designation rights. So you're going to have to look at your voting agreement, and you're going to have to look at their certificate of incorporation to figure out who could fire whom. You know, by and large, boards operate based on majority rule. So, you know, you just need a consensus of those VCs to you know, get whatever needs to get through on the board level. All right, I answered that question. If I generate consultancy income through the company, keep it growing, will it be a problem for VC rounds? You know, this comes up from time to time. I think, you know, one of the issues of having maybe different lines of business in your company is if you're selling a piece of your company, then they're getting that line of business, whether or not you want them to get that business. So I would be, you know, if you're going to stop the consultancy and focus on something else, I mean, I think that's fine. It's just part of your business plan. But if you've got like kind of different products and other things bundled in a business, well, when they make an investment in that business, they're making an investment in the whole thing. So that's when some corporate structuring, we want to do the work to do the corporate structuring. Another fee question, happy to chat offline. Does the employer own my IP if I employed while I'm building my startup? You need to take a look at your, and these things have different names, but proprietary information, invention, and assignment agreement. And then in California, it's labor code 2280 or 2270. I'm blocking on it at the moment. But if you work on, and I'm not a labor and employment attorney, I have been sort of noodling over and curious as to what this rule is going to mean in this COVID environment where we're all working from home using a lot of our own resources. But, you know, there's a statutory safe harbor in California. So the answer is maybe. You got to take a look at those agreements and figure out where you've been doing the work and what resources you've been using. All right, so I'm going to just kind of take a quick spin through a couple of others because we're coming to a quick close. Email address is jgordon@pulsinelli.com. Please don't give me any confidential information. I do keep office hours, usually sort of Friday afternoons, not this Friday, but the following one. I'll be back in the office. Man, there's just so many great questions. I'm so sorry. Let me see if I can answer one more. Do you find better known recognized VCs to be easier or harder to negotiate on term sheets? Is it still typical to see more favorable deal terms from strategic VCs versus financial VCs? I'm just thinking through. It does anecdotally, I would say, you know, brand name VCs, especially VCs that have built a reputation for being founder friendly, do generally have easier, you know, or easier to negotiate with and have more founder friendly terms. I mean, that's kind of no surprise, right? You know, if they've earned a reputation, okay, you'd expect to see that. in terms of more favorable deals from strategic VCs than financial, I would say probably yes, kind of. I mean, many times it's sort of more favorable on the economic side, but in terms of some of the control rights and some things in some, maybe some commercial hooks or tie-ins, it might limit you. Now, maybe that is absolutely the right move for your company, and that's great. But I think it's not truly an apples to apples comparison in strategic versus financial. So you kind of got to get in the weeds, and absolutely strategics can be as good or better than financial, and same the other way around. And then many times they kind of work best when they're coming in together. So you kind of get the best of both worlds when you do that. So with that in mind, we've hit 8:30. It has been a fantastic evening. Thank you for spending it with me. I want to thank Rob Lau and Idea to IPO, my host, Jennifer Stowell, for introducing me today. I want to thank each of the attendees. We will follow up with a video in a week or so, if you haven't gotten it sooner than that. And I want to let you get back to building your great companies, and I'll see you next time. Take care. Have a great night.